Hey, welcome back everybody to the Midtown View. I'm your host, James Wenk, and joining me today, we have Michael Rutter, principal and founder of Rutter Property Group. Michael, thanks for coming on today, my friend.
Thank you, Jim.
Great to have you. We got an absolutely beautiful afternoon here in Midtown Manhattan. But listen, I was telling you kind of before we started, we've had a lot of interesting guests come on, and you and I have a kind of common bond going back 25 years or whatever it is, that we went to the same college, Ithaca College. But we both ended up in the commercial real estate business, and you have a very, very specific, successful niche within our commercial real estate business, and that's within the office condominium sector. Yeah. So, for many of us or many of our viewers who don't know a lot about the office condo segment of our market, we all often talk about leasing office space, subleasing, buying and selling buildings, but there is a real segment of our marketplace here in Manhattan around office condos. So just kind of wanted to open things up and hear how you fell into that side of the business, and there's a lot of ways we can go throughout the conversation, but would love to just hear about how you found your way into this segment of the business.
For sure. Well, first of all, thank you for having me on the Midtown View, Jim. Glad that post-college, 25 years later, we're still hanging out.
Definitely.
So my firm, Rutter Property Group, I founded in 2010. And prior to that, I spent about a decade working for Francis Greenberger and Time Equities, who's a privately held real estate investment firm. And Francis had owned a small portfolio of office buildings around the city. And one particular building in Lower Manhattan was a large law firm was vacating. Cadwalader was moving to 500,000 square feet at the World Financial Center. And this building, 125 Maiden Lane, which Francis had owned for many years, was going to clear out. And like many buildings in the Wall Street area in the 2005-2006 era, Francis had considered converting the building to residential. We had full plans to make apartments out of this building, but at the time we had been fielding some interest from nonprofits and other groups like that who might be interested in purchasing their space. So Francis was his idea to go through the process prior to filing for a full condo resi conversion, but to file the plans to do an office condo conversion. And let's give that a 6-month try, see how that goes. This is like 2005, 2006. By 2006, we had sold out a huge portion of the building to really high octane nonprofits and users like the U.S. Fund for UNICEF, the Jewish Forward newspaper, the Guttmacher Institute, the Lower Manhattan Cultural Council, and many other groups saw this opportunity that they can own their space, they can finance that purchase, and they can benefit from the long-term benefits of office ownership rather than continuing to throw money away in rent. So that deal was a tremendous success for Francis, for all of us. He went on to 1031 the money, the proceeds he got from the office condo sales, into a handful of other office building acquisitions around the city, which he converted from office rentals to office condos. We made it through the financial crisis in 2007, 8, 9. Sales picked up again. By 2010, things were going well within this niche, and I felt like the city had more room to grow. Much feels similar to today. I felt like spring out there. So I left Time Equities to start my own firm to grow this niche of office condo sales, not just represent Time Equities, but other owners, sellers, developers, and groups like that, and in some instances, buy properties on my own account.
Amazing.
So that's what happened there. Francis and Time Equities by no means like invented the concept of office condos, but he was, really instrumental in sort of bringing this back into the consciousness and as a strategy in New York. Certainly it was the first of its kind sort of transaction in Lower Manhattan, and we grew that niche from there.
So you had this kind of old office building that a law firm moved out of, and we're thinking about the next phase for the property. Okay, let's convert it to residential, which is kind of funny because that whole conversation is back today. For especially these older buildings, but and then you kind of went down this route of converting, or positioning it as selling individual office floors, and it turned out to be kind of a home run, and it validated that there is demand in the market for ownership.
Yeah.
So the purchasers of the floors were nonprofits. So nonprofits, they get certain economic benefit, right? I don't think they pay property taxes.
Sure, there were nonprofits, for-profits, doctors, all sorts, but nonprofits don't pay real estate taxes when they own. They do when they rent. They're also eligible for tax-exempt bond financing, specialty financing for nonprofits that is high loan-to-value, low interest rate, and a lot of these buyers took advantage of that. And it was really just a great value proposition, not just for the nonprofits, but for a lot of buyers out there where effectively they were owning their space, they were paying their expenses and paying a mortgage, and it worked out on an annual basis not that different from what they were paying in rent. And then on top of it, they got tax benefits and the values of the properties appreciated. Amazing. So we've gone on to sort of run with this hyper niche of a business. I believe that being highly specialized in business is a key to success. There's riches and niches. And this was an area of our market that nobody had really specialized in. And it's a small component of the overall office market, but still sizable enough to build a business around. And here I am, continuing to go and grow with it. And I think it's increasing as a component of New York's office market. I mean, just to sort of set the stage a little bit, first of all, when we say office condos, we mean where it's a building where there's 3 or more owner-occupiers, businesses or organizations who own and occupy their space. We're not referring, sometimes condominiums are used as like a financial transaction where an investor may own the retail portion and a different investor owns the office portion, or even the Hudson Yards in some instances were structured as condominiums, but we don't really count that for our stats. Ours are true office condos that you own and occupy, much like you can own an apartment or rent your apartment. Here, instead of businesses renting their office space, they can own as well. So office condos in New York make up 2% of the 500 million square foot office market. There's about 12.5 million square feet of true office condo space citywide, and that's made up in about 113 buildings, about 3,300 unit owners. So while 12.5 million square feet is like, the stretch of Park Avenue here, it's like a really drop in the bucket compared to the overall office market. It's actually the size of many downtown business districts in other cities around the country. It's actually sizable. So for me, it was a big enough market for me to transact in and build a business around. And I think because of current market conditions and some of the dynamics that's going on now, some of the issues because of interest rate rising and increased vacancy in New York and some of the distress we've seen around the office market, it's a really ripe time that we're in now to grow the size of the office condo market, to create new condominiums, to file offering plans with the Attorney General and offer more space to users, to businesses, to nonprofits, to any group who might think that this is a good time to actually buy your space and own it and secure a portion of Manhattan at really discounted prices.
Yeah, I was going to say, definitely want to kind of lean more into that because we obviously know the Class A and the trophy office market is very robust. It's performing at a very high level, very low vacancy, very high rents. But when you look at the B and the C market, and mid-block buildings in select parts of Midtown, and then in downtown Manhattan, specifically east of Broadway, where you have the older stock of buildings, where those pockets have the highest levels of vacancy. Those, I know there's been a lot of discussion around residential conversion, and we do have a consistent need for more housing, but there also seems to be a very robust need for these office condos, because what has been proven over years is that there seems to be a continuous demand from nonprofits, healthcare, schools, and other uses commercially for these buildings. Yeah. So I'd love to kind of hear, your perspective on that, because I don't feel like we hear enough of the office condo conversation as much as the need for residential.
Well, I think that the big wave of conversions from office to resi is a really wonderful thing. It's like a win-win-win, and it's very needed, and I hope it's very profitable for those daring developers who take on such a big project like that. I think it's great. And I think even if you own a building that does not convert, you're still the beneficiary of it, because you have less competition, because other vacancies converting to resi and beautifying the neighborhood. So I think that's great. However, it's a big undertaking. It's pretty binary. Once you convert to resi, there's no going back to office at that point. It better be a success and highly profitable. Where I think that office condos offer a really elegant solution to building owners or their lenders who might be taking back buildings, who are plagued with both vacancy and distressed debt situations, distressed capital stacks. A lot of the distress we see in the B and C class office market is not just like demand from tenants. I think there's been a huge increase in demand from tenants looking to lease space, and there's a return to office, and just people recognize they need the office, but a lot of those buildings have problems because they're underwater on their loan, they have a loan maturity coming, or some other set of issues. And what office condos can do, and what they've historically done, a lot of the premier office condos that exist in the market today came out of markets much like this, like 633 Third, 1 million square foot class A minus office building on 3rd Ave and 40th Street, came about in the early 90s when the building went down to about 30% vacancy or occupancy and was taken back by Travelers Insurance, who couldn't get the space leased, and converted to condo and found some UN-related groups to buy off chunks of the building. And I think that's what could happen now. You can convert to condo, which is a process, but a fairly easy, smooth, and inexpensive process that does not require physical construction. There's no physical conversion. It's like, a filing, and sell off blocks of the vacant space to users, nonprofits or for-profits or businesses even at cheap prices, but pay down debt, keep the occupied income producing portion, maybe the retail, maybe the occupied floors, and live to see another day and benefit from the appreciation that we know is going to come in New York. So we are working on some of these conversions now, and we think more of this is going to come about.
So I've kind of a crazy question. So, let me go back to like the Class A market and trophy market for a second. You may recall the investment firm KKR, big private equity firm. They were at 9 West 57th Street for a long time, and they actually went ahead and purchased I'm going to say 6 or 7 floors at 30 Hudson Yards, maybe 5 years ago or so. And I kind of heard a story that, the developers of Hudson Yards were showing the founders of KKR, the Columbus Circle building, where Deutsche Bank now is, but Time Warner moved out, and it's on 57th Street, and, hey, let's show you this building that's only 15, 20 years old. And they had a model of Hudson Yards in the office, and they're like, why don't you tell us about that?
Yeah.
And they went ahead and they purchased their 6 floors, whatever it was.
Yep.
But I guess knowing that the real estate here is in such demand and there's only so much supply. Do you see a world where some of these big investment firms, go ahead and try to purchase their floors? I mean, think about one of the most iconic buildings in the world, 375 Park Avenue. And if you're a major tenant in that building, which there's, one or two, for them to approach the ownership and say, look, based on the rent we're paying, it's worth X, but we'll give you X plus plus plus. Do you ever see that, foresee that happening? And because, you're locking down a piece of office space that your investment's going to be good for forever.
Well, I think that world is here already. I mean, correct me if I'm wrong, but some of the biggest companies in New York City already own and occupy their space. And I can assure you they did that same calculation that, a small individual office condo owner who buys from us on one of the projects we worked on did. For example, Google, are they one of the largest private owners in New York City? They don't rent, they own. After being a longtime renter, they purchased multiple properties. Amazon purchased the Lord & Taylor building. They paid around $1,000 a foot for that building and then did a gut renovation of it that had to be approaching $500 or $1,000 a foot. They invested heavily on owning a premier building in New York City. Citibank, Goldman Sachs, all of those, BlackRock, JP Morgan, exactly. And that list goes on.
I guess we think about these as very large corporates, right? Whether they're tech, banking, but kind of going back into that, mid-scale, like the KKR reference. I guess the point is if you're seeing it on the big scale and you're seeing it on the lower to mid tier, it's only time where, a company that's 100,000 square feet, I'm making that up, says, I want to buy my floors.
Well, I think a couple things. Also, I just want to point out, you're seeing it on the retail side. We've been seeing billion-dollar sales to users to Prada and Dyson. And just yesterday, I read about the Ralph Lauren's purchase of their retail condo on Spring Street that they'd been a long-term tenant on, and they were competing to renew the space. And in order to secure it, they paid $132 million for a small corner retail on Spring Street, which equates to about $30,000 a foot when you just count it for the ground floor space and don't attribute value for the second floor or whatever. $30,000 per foot to own, maybe it was $29,000, but to own their retail condo there and to secure their space. And in some respects, it seems indefensible. What could possibly behoove them to do that? But a lot of things. It's permanence, it's securing ownership in the best city and a great location, but even their ongoing carrying costs. And I would imagine their borrowing costs are low, or they had the cash and they're paying their operating expenses, just worked out to probably being more than what they'd pay in rent, but not that dramatically more. And certainly over time, I suspect that $132 million or the $1 billion that Prada paid or the $1,000 a foot that Amazon paid for Lord & Taylor will certainly be proven to be a great purchase. It just takes a little time. However, the area that I've played in has been more of the B and C class, some A minus, but the B and C class product. We've been really active on representing owners on the conversions of sort of B class, mid-block office buildings in the West 30s. And my old boss, Francis Greenberger, would always say that a good building and a good location at a fair price, there's infinite demand from it. And that demand might be from groups who show interest in buying an office condo, but that demand also might be from all of the 5,000, 3,000 to 6,000 square foot tenants out there in Midtown who are in the textile business, the apparel industry, the doctors, jewelers, all of those types of tenants. And it's not 5,000, it's probably 20,000 tenants out there that they don't even know that they could buy, that they could own, that they could do what Google and Amazon have done to finance a speculative office building investment today. maybe 50% debt, something like that. But if you're an owner-occupier, and the ones we're selling to, they get, in some cases, up to 90% loan-to-value on their purchase price and 90% loan-to-value on their build-out costs and their closing costs. Some of the buyers, maybe about 40% of the buyers we sell to, get 100% financing, and it covers their whole purchase price. And their ongoing costs with their mortgage and their operating expenses are not that different than what they'd be paying in rent. So I think as more people are aware of this, and even more importantly, as more of these opportunities exist, there will be more businesses will recognize that this is a good opportunity to own. Fee simple ownership in the middle of Manhattan.
Yeah, I mean, you have to imagine, from where we were 5 years ago as a city to where we are today, how it just rebounded, especially over the last 2+ years. But office demand way up, office occupancy, we're nearing pre-pandemic levels. I mean, granted, there's a fundamental shift with more hybrid work amongst more businesses, but other business sectors are back in the office 5 days a week, just full stop, financial services. But even in a hybrid environment, you're still using your office 60 to 90% of the same time as you were using it pre-pandemic. And there's, values got depressed, right? Correct me if I'm wrong, over the last, rates went up, values went down. And then now I have to imagine it's got to be rebounding, even though the rates haven't dropped so much. The occupancy's up, the demand's up. So just talk to us about, how pricing has evolved and value and how much does interest rates really impact it or not. So love to hear how the economics work.
I like hearing from you, and it feels good to hear from you and other brokers of your caliber who are handling, these higher end financial firms who are all profitable, who are all expanding, they're back to work and paying record rents in the Class A and some of the premier buildings and submarkets around the city. However, in the B and C class markets and some of the other submarkets there, while the demand might have rebounded or be in the process of rebounding, the values are still at levels, and by values, I don't really mean lease rates. I mean the sales prices of these buildings are at levels we have not seen since the early 90s. Like at no point in my career or yours were some of these buildings trading at a price per foot that they're trading at now. We're seeing, really good B-class buildings in the West 30s, and I don't even mean like 9th and 10th Avenues, I mean between 5th and 6th, selling below $300 a foot. Like, it's inconceivable. The world has gone mad. The pendulum has swung too far. These are buildings that would have sold for $600 to $800 per foot pre-COVID. I read Sam Zell's book, and he talked about his strategy was simple. When values came down 50%, he'd buy every corner building he could. Well, we're down like 70% in some cases. And these buildings are so cheap, as if like office buildings in New York are totally obsolete. I mean, they're selling at a fraction of their land value. The world has gone mad. And as far as I could tell, it's the best opportunity for investors to buy these buildings first and foremost. Like, you own this, in a very short period of time, you will be rewarded because the market will recover and common sense will prevail. Personally, I think that if you do buy those buildings, one of the best strategies is an office condo conversion. Pre-COVID, we were selling office condos between $900 and $1,100 per foot, which equates to like an annual carrying costs, if you're not a nonprofit, if you're a for-profit and you pay real estate taxes, around $50 to $60 per foot. Okay, you get a mortgage, you pay your operating expenses, pay $1,000 a foot for an office condo, and it costs you about $60 a foot, pretty similar to what those types of rents were. Now, if you buy an office condo at half that, at $500 a foot, it's costing you around $30 a foot. And so I think that where you can buy buildings for sub $300 a foot And I think in a short period of time, you'll be between 5 and 600 or between 5 and 700 a foot where you could sell office condos. That is as big of a spread and as big of a multiple on your money that you can make by effectuating an office condo strategy as I've seen in my career when we were doing it with Time Equities or on behalf of Metal Partners or Hidrock or other owners that I've represented. They were hoping to double their equity or earn a reasonable and a fair IRR. We're talking about multiples on your money you can make now because the pendulum has swung so far of how cheap these buildings are to the money you can make first and foremost by leasing it up and ultimately earning a really fair and high rate of return, but even more so by condominiumizing the building and selling out floor by floor to users who pay a premium.
Just think about it. You're talking about in the 30s between, say, 5th and 6th. If you think about the commuter hubs, Penn Station, Grand Central, we know, with Penn Station being renovated around, largely due to Vornado, and then obviously the Hudson Yards to the west, and then Grand Central has performed extremely well, right, as a primary recovery mode. It's like it's only like the convergence of those two areas is the 30s between 5th and 6th. And so small to medium-sized businesses who may not want to pay the premium to be right next to Grand Central, the $70 rents, the $90, $100 rents, now could pay much cheaper rents if somebody who owned an office condo is going to rent it out, or they could, if they have the capital, can get the financing, they can buy at $300 a foot, which would be almost the equivalent of their carrying cost at $30 a foot. Add a little premium on top of that. It's like rent in the 40s, low 40s.
Well, not at buying at $300 a foot. That's less than that. That's buying the whole building. But buying an office condo, even at $600 a foot, is the equivalent of paying in the low 40s in rent. And we're often asked, well, who are your buyers? Well, our buyers, like we talked about before, are nonprofits who are tax exempt and doctors and jewelers and this and that. There's certainly different sectors that have been really active buyers of office condos historically. But I would say if there is one common thread between all of our buyers is that, or I'd say maybe 80% of our buyers, is that these are businesses of all different types of sectors where the principles of the firm were born abroad. If you were born and you ran a business in Beijing or Bombay, chances are you own your space, where like office ownership is a far bigger component of the market there. So when you come to the US and you're living here and running a business and you're given that opportunity to buy, you jump at it. So 80% of our buyers in all different types of business lines, the firms are run by a principal who is born abroad. And there's a cultural preference towards ownership, where Americans are spooked by the negative media on New York and the New York office market and tariffs and all the stuff that the media pumps into us. Foreigners are like, New York's on sale 50 or 70% off, plus I can finance 90 to 100% of this. And my ongoing costs are not that different than what I'd been paying some other guy for rent. Like, I don't need some Excel analysis on this. I'll sign a contract. So we have like demand, tremendous demand from groups like that. And frankly, they're not as like impressed by some of the premier buildings, and they're not interested in paying those rents or those sales prices. They want, as Francis said, a good building and a good location at a fair price. And I think that's what all of those buildings over there offer. And that's sort of the area that I swim in.
I love it. I love it. Michael, we can go on for like hours on this because this is fascinating. There is so much around, what's this trend of office condominiums and conversions. And, I know we don't have any bar charts or graphs, but I have to imagine it's trending in the direction where your business has clearly been excelling, and you're handling both the supply side and the demand side. of this. So
Yeah, on top of that, I'll just say that we all experience this to some degree where you're out there and you see a dynamic occurring in the market that makes clear sense to you because you're an expert in this and you have knowledge of something. And that happened to me and has happened throughout my career. I see the opportunity at different times in the market or at different properties or different units or different prices. So I've pivoted my business to be somewhere between 20 and 50% in acquisitions. I've mostly through COVID, but I currently own 7 properties that are mostly just office condos that I buy and lease out and earn income. Some of those have been properties I bought with money I've earned from commissions, and some of them I've bought by raising money and syndicating those deals, in some cases from our colleagues. And that's been a really great pivot and avenue for my business. I just feel like it's shrewd to be out there and seeing opportunities and taking advantage of them. So during COVID and this market and these dynamics have really been a good opportunity for me to increase that portion of the business. And I'm really spending a lot of time and resources increasing that and look to do more of that as well.
I love it. I love it. We'll make sure we're all on your list, your syndicate list.
Yeah.
Well, listen, I think I mentioned before the show, we close out these sessions by, I ask every guest if they have some predictions for the future. So, we have our little crystal ball we put in the middle here, but just would love to hear, we'd love to have you back a year from now or so, and just kind of what do you see that's going to be different than what we're seeing today?
Well, it's funny. It's like what will occur comes out of what we are seeing today. So what do I think the future is increased rents, increased occupancy, increased values, increased just, this negative sentiment around New York and New York office. I think that will dissipate because that's what I'm seeing today. So that's what will occur. It's a laggard. Rents go up, occupancy goes up, vacancy goes down. But in a year from now, I believe that will all be what we're seeing out there. And I'm not always an eternal optimist. I was pretty pessimistic in certain parts during COVID of what the impacts of interest rates and COVID and work from home will do on the office market. But when we go from Class B and C office buildings from $600 to $800 a foot from pre-COVID down to sub $300 a foot now, I would imagine we're either at the bottom or past the bottom, or the pendulum has just swung too far. And when I walk around the streets and it's packed with people doing business and shopping and the most diverse city and diversity of all sorts, like different industries and business lines and, all of these different cultures that I work with that are into so many different sectors of the market and are so profitable, I think the future is very, very bright for New York. And, all aspects of our market will see an increase.
Love it. I love it. Well, we'd love to have you back a year from now.
Thank you, Jim.
Hopefully it's another beautiful spring day. But dude, this was awesome.
Thanks for the time.
Yeah, man. Thank you.
Absolutely.
Thanks everyone for joining us for another great session of the Midtown View. I'm Jim Wenk. Until next time, we'll see you.